A lot of people may hear the term covered call and immediately thinking that great, it's a free income. I already own the stock, so why not sell and collect the premium? So the truth is that the covered call is not free money, it's a trade-off. And if you use it in a good way, it can generate very good return. But it does involve risks. So in this video, I want to break it down in a very simple way. First, I want to tell you what a covered call really is. Second, I will tell you 3 major risks. And lastly, I want to tell you how I personally use the covered call and cash security puts together without touching my core position to generate consistent income. If you don't know me, I'm Professor Fang. I got my PhD from Stanford University with an engineering degree. And here, from an engineering perspective, I teach you how to invest as an engineer and teach you the mechanism between stock trading and option. I'm not a financial advisor, so all the information here are for entertainment purposes. Remember, all investment involves risks. So first, what's a covered call? So a covered call means that you already own certain share of a stock, let's say just 100 shares, and then you can sell one call option against 100 shares. So why it's called covered? Because you already own the shares, and so if the buyer exercises the option, you can deliver the stock without any worry. In a simple term, a covered call means that you get paid today, and in turn, you give someone else the right to buy your shares at a fixed price called strike price in the future before a deadline. Let's do a simple example. If you own 100 shares of Apple, and say Apple is trading at $250 today, and you sell one covered call with a strike price at $260, expiring within a month. Then let's say that you get $5 of premium per share. Then what you get for today, you get $5 times 100 shares, $500 right away. Sounds very good, right? You already own Apple and you get $500 for free. It's not for free. You get obligations, right? Within 1 month, you have the obligation to sell the 100 share of Apple at strike price $260 to the buyer of your covered call. So there are 2 possible scenarios. One, within a month, the Apple price is between $260. For example, Apple is like a $255. So the buyer of the call have no reason to exercise because he can buy at $250 while he buys at $260. In that case, you keep your shares and you get $500. In another scenario, the Apple price go above $260. For example, the Apple jumps to $275. Then the buyer has the reason to buy stocks at $260 from you because he paid the price for the right? So he eventually buy 100 shares from you at $260. What do you get? You do keep the $500 as premium, but you sell 100 shares of Apple at $260 to the buyer of the call, even though the market price is $275. So for the covered call, you made immediate income, but you cap your upside. In this case, you cap your upside of Apple within that month to $260. Before I get into the risks of covered call and how I handle it, I want to announce an option class I'm launching. Most option courses have the same problem. They're either too shallow to be useful or too theoretical to apply in real investing. So my course is built in a different way. I give you enough theory to truly understand how options work, what's the mechanism, but also enough practical depths for you to generate income, risk control, or better investment decision. It's a well-structured, well-engineered, practical course for serious investors. The course, I'm preparing it and the course go live August 1st, 2026. Now is the early bird at $399. After that, it will be $699. Okay, let's talk about the risks of the covered call. I would say the biggest risk is assignment. If the stock rises above a strike price, your share may be called away. That sounds harmless at first because technically you still make money of the premium, and maybe you bought the stock at a lower price, you do get that upside, but that upside is capped. But the real problem is that you lose the stock. Maybe you want to invest into that company for 5 years. For example, a lot of my investment who give me significant increase are over years. For example, Rocket Lab. I started invest at around $3 to $7. Those are very struggle years. I keep buying shares, and then I wait 3 years until it skyrockets. Do not play capital call with your long-term investments. They can be called away, and I can feel the frustration. You have to figure out another way at a good price to buy it back. That's very struggle. The second risk is the opportunity loss. You made a premium, but you cap your upside. In our Apple example, right, you get a $5 per share of premium, but if the price is at $175, that is $15 above your strike price, you lost $15 of the upside. And so the third is about the tax. A covered call may look great before tax, but depending on your holding period and your tax situation, the actual after tax may be much less attractive. If your share gets called away too early, you may lose the benefit of long-term capital gain treatment, which is much lower than the short-term capital gain. And the premium will also be taxed in a less favorable way. So you should never evaluate your covered call by asking only how much premium did I collect. So the better question to ask is, was the premium worth the upside I gave away, the flexibility I lost, and the tax consequences I triggered? For the tax, everyone's situation is very different. You have a different income and you hold your share for different periods of time. I encourage you to talk to a tax expert before doing any investment. So the last section, I will introduce my approach to covered call and the cash secured puts, and how I combine the option with the fundamental understanding of a company. Before that, please consider hit that subscribe button. That will be a good help for me, and you can get more of high quality investing video I produce every week. At what strike price, over what period of time you sell a covered call? The key question you ask yourself is, at what price you're willing to sell? And the real question behind it is, at what price the company is overvalued? At the same time, the cash secured puts, the question you ask yourself is, at what price I'm willing to buy in this company? Which means, at what price this company is undervalued. I'll give you an example. So I'm an investor of Rocket Lab. So I have my long-term position, I never touch, but I do play with covered call and cash secured put with short-term positions. How I value the Rocket Lab? I compare Rocket Lab with SpaceX, and I have the following assumptions. First of all, SpaceX IPO has a value between $1 to $1.75 trillion. Rocket Lab's price to sell value should not be higher than that of the SpaceX, simply because SpaceX is a much matured and positively cash flowed company. There's no reason that Rocket Lab price to sell value higher than SpaceX. With that, you can get a rough upper bound of Rocket Lab. And also you can get a rough lower bound of Rocket Lab. At this position, my analysis, remember, is my analysis, is not investment advice, is between 85 and 65, which means I sell cash secured put at a strike price below 65, and I sell covered call above 85. In that case, I have 3 key scenarios. First scenario is that the price is moving between 65 and 85. I gain a premium, and my position are not being called away, and I'm not forced to buy at any price. The second scenario is that the price go below 65. I was forced to buy some shares from Rocket Lab at the price that I'm happy. In the meantime, I'm getting premium for both covered call and the sell put. The third scenario is that the price is moving above 85. some of my short-term positions for Rocket Lab being called away at a very ideal price. I want to sell it anyway. In that case, I'll also get a premium for both covered call and cash secured puts. So that's 3 scenarios. In all 3 scenarios, I'm happy. So I can do this with confidence. Of course, my price range move according to the new data I get, and I update my price range. That's how I use covered call with cash secured puts. In this case, you buy at the price that you're happy, you sell at the price that you're happy. And you can do this back and forth over time. Okay, that's all for today. Hope you enjoyed this video, and I will see you next time.